Welcome into a daily editorial here on the KE Report. I am chatting with Jordan Roy-Byrne, founder and editor of the Daily Gold, and this is going to probably be the only interview that I will be able to get up besides a company update before I head into that Sprott conference. Please, everyone, keep those emails coming if you want me to chat with any of the companies that are on site there. Jordan, let's start off, because we are chatting before the Fed meeting. Let's just quickly address how you look at these statements. I know a lot of the time we see a lot of market volatility, but something you and I have talked about, that these Fed statements, whether it is the Fed or even another central bank, cause a lot of short-term noise, but it's always good to take a step back and, in a sense, unless you are a day trader, ignore that noise and really take note of the longer-term trends and some of the more impactful longer-term actions that are going on within the market. What about you? Should there be any impact on investment strategy going into or even shortly after this Fed statement?
Zero. That's the answer, Corey. Because the Fed follows the market. That's what they do, and they've over the last since December. I think the 2-year yield I'm looking at, it peaked. I think it peaked in November. I'm looking at a long-term chart, but that's been coming down aggressively since November, and so they follow the market. And the Fed has, for the last several months, really the last 9 months, 6 to 9 months, they've been woefully behind the market. They've had these guys come out and make these statements where they try and talk tough. Oh, we're not going to do, we don't need a 50-point cut. That's way too much. The Fed follows the market, and the market moves based on economic data, inflation, the dollar, what's happening around the world with foreign central bank policy. Like, all these things matter, and the market judges this day in, day out as time goes forward. And so whatever the Fed says is just a bunch of nonsense, because whatever they're going to say today, they're ultimately going to follow the market. And if we're looking at the market and the 2-year yield as a proxy, they really should cut by 50 today, but they're probably going to cut by 25. And they have to lay the groundwork for cutting another 25 in September. But I wouldn't be surprised if they say something and try and act like, oh, this is just an emergency cut. This could just be a one-time cut. We'll see what happens going forward. And who knows, maybe, the market participants will flip out and think, oh, well, they could be done. They're not going to cut anymore. So precious metals have to sell off. That's a possibility. And looking at precious metals, Corey, the trend has been very strong in the miners. I mean, they are selling off here before the statement. And, I mean, that to me is a good thing, because precious metals have been fairly overbought. And I'd rather see the correction now than precious metals continue to rise, and then we see a correction from higher levels that's a little more severe. So that's where I'm at. I have no idea how the market's going to react. And it doesn't influence my investment policy, and it really shouldn't influence yours either. I mean, just focus on, if you're a stock picker like I am, you want to focus on your individual companies, the fundamentals, and that's how you can and try and buy when things are out of value and they look like the charts are turning up. That's what I try and do, and just ignore the reaction to the Fed. This reaction that we get the day before, or the day or two after, that's all just noise. Once that goes away, it matters what happens with the market, because they'll judge where Fed policy is going. I mean, these guys still thought they were going to be hiking rates earlier this year, and we're 4, 5, 6 months after that, and now they're cutting rates. So, I mean, they don't know what they're doing.
No, you're not going to get a disagreement here, especially from the comment that they are very much following the market. But taking aside what they say today and the market reactions, can't we assume or agree that the trend does seem to be lower rates? And this is the first time that the Fed is going to be cutting rates in about a decade. So no matter what they say or what kind of guidance they get, it seems like the path is to lower rates.
Yes, and the only argument against that is people could say, well, this could be like 1998 or 1995. And I don't think that's going to happen. I think this is the start of a new rate cut cycle. I mean, I think it's more likely that's the case than not. And um, even though the economy, it looks like it's holding up okay, but I mean, there are pockets of weakness. The dollar is really strong, and that's not a good thing for the rest of the world. So, interestingly, Corey, the stronger the dollar gets, the more likely the Fed is to cut in the future. So that's a good thing for gold, and possibly why we see gold holding up so well against foreign currencies. And so that and also if we look at the 2-year yield, I mean, the Fed is 50 basis points above that. Like they should cut 50 actually if they want to be where the market is. And also, Corey, if you look at, I mean, around the world, you're seeing negative yields in these other bond markets. And I mean, I don't know. I mean, as long as that continues, that's going to put some downward pressure on yields in the U.S. Because why would you put your money in Europe or wherever where you're actually losing it and you can't earn a return, but you could put it in the U.S. and, which is a deeper, more liquid market, and you could earn 2%. I mean, even 1.85% on the 2-year. So that, I mean, that around the world, that could keep downward pressure on yields.
Yeah, very much a global game and something that we have talked about. Plus, yeah, just consider how much more the U.S. Treasury and bond market is paying than other places around the world where it's actually not paying you anything. It's negative yielding instruments. Jordan, can we quickly look at that GDX chart, though? Because whether you look at the daily chart, the weekly chart, and now even the monthly chart, we are seeing, yes, kind of overbought territory, or at least even on the monthly chart, some of these strength indicators and momentum indicators reaching levels that we haven't seen in over 10 years, or really at the peak of when gold was and the precious metal stocks were topping back in around 2010, 2011. This seems like very early innings, but what levels are you going to be watching? If we are due for a correction in GDX, where do you think it could bottom? Where do you think it would be another good opportunity, good entry opportunity?
25. I like to babble on, Corey, but it's a one word, or that's a 2-word answer. 25. Previous resistance, when it's broken, it becomes support. And for GDX, it's pretty clear. It's right around 25. Right now, it's trading at 27.05. So again, 25. That's what I would be looking at.
Hey, fair enough. That's actually not that far down, only about 7 to 8%. So very encouraging. Now, when it comes to stocks, you and I were chatting about a few of the stocks at the Sprott conference and how we like some of them, how we dislike other ones. What are you trying to focus on now that we are seemingly in a rising gold environment? What fundamentals do you pay most closely attention to?
Well, that's a very good question. I mean, I try and pay attention to the same fundamentals as I normally do, unless I'm making an optionality bet. I mean, really what I'm looking for is value for something that for whatever reason hasn't moved. Another thing you could look at or look for is companies that have sold off because they did a financing 4 or 5 months ago. That's a way that you can find value right now. If a company has sold off because they have paper coming to the market, and that's the reason they've sold off, it has nothing to do with the fundamentals or the value of that company. Those are things I'm looking for. It's really just a value situation. What is the value of that company based on what they own? I mean, I don't really want to look for any like real deep out of the money optionality plays. I'm not interested in something that needs like $30 silver or 1,700 gold to be economic. That's too much optionality for my taste. But other than that, it's really just value and looking for things that people are not aware of. That they're not being covered by that many companies, and that they have a chance to unlock value as time goes by. And in addition to that, Corey, you can also the stocks that you own that have been doing well and maybe subscribers or followers missed those, you can buy those when they pull back, because there will be pullbacks. I mean, if you're looking at your list of stocks and something is really overbought and stretched, you don't need to buy that now. I mean, at some point in the future, that will correct, and there will be a better buying opportunity.
So you're waiting for pullbacks in some of those good stocks and those stocks that have run. But what about the argument that all the good stocks have already started running? You still think that there are stocks that have been forgotten, kind of left behind during this recent run just in the last about 2 months?
Yeah, I mean, there are some things here and there. They're not, I mean, they've been moving, off the top of my head, some things I have on my watch list, they've been moving a little bit. They're not extremely overbought. So those are the things that I would look at. Things, you don't want to just buy the things that have been the cheapest. I mean, things that are trading around their all-time lows, like prospect generators, for example. I mean, not to go off on a tangent, I know there's a couple people, there's a niche of our industry, people who are very smart. They know way more than me. But when I look at the charts of most of these prospect generators, I mean, they need to be taken out back and just shot because they've been around for 15 years and they're trading at all-time lows. So though something that's trading around all-time lows, Corey, you don't want to necessarily just go for those and buy into those because there's a serious problem if they haven't been able to capitalize on this rally. So you don't want it, like right now, you don't necessarily want to chase the absolute strongest stocks. You don't want to buy the weakest stocks. You want to look for, first and foremost, look for value. Look for something technically that's in between. Maybe it's close to a major breakout. Maybe it's been trading up a little bit, but it's not extremely overbought. So those are the things that I'm looking for. Look for value. Don't buy the absolute weakest stocks because that's a huge red flag if they haven't been able to move in this kind of a run in the last several months. So there's no one good answer, Corey. I guess I've said a couple other times, I'll repeat myself. I guess just look for value because it is out there. It can be found.
Yeah, you know what? I do still know some stocks that haven't run nearly as much as some of these almost high-flying metal stocks that have really been moving even before the market got going for some of these juniors and even these mid-tiers. But you know what? There's still that argument that some of these stocks that have run, you wait for a pullback and you buy the highest quality ones because the market is telling us a lot. The companies that manage to stay funded during that very slow 5 to 6 year range bound trade, and the ones that have developed projects that are becoming more and more attractive, especially if the metals prices continue to move higher. Jordan, great chatting with you. Thanks for taking some time ahead of this Fed meeting. I'm heading into the Sprott conference, so everybody please comment amongst yourselves. Send me emails, fleck@kereport.com. And Jordan, thanks for your time today.